and thank you for joining this call, our quarterly guide to the market update. Obviously, a very timely call with what's happening in markets at the moment and the level of uncertainty around the world we're seeing reflected in the performance of risk assets as well as safe havens, and thinking about the implications of what we're hearing out of the US administration and how it's reverberating around the world. So today on this call, we'll obviously be going through some of the new charts we've put into the guide to the markets for Asia to think about how we're seeing this uncertainty evolve and thinking about the tariffs more closely. So I want to talk about what we're seeing in the markets at the moment. Obviously, things are very unnerving given the large drawdowns we've seen in equity markets around the world. The Russell 2000, the NASDAQ, moved into bear market territory. The S&P 500 has been in and out of a bear market as well. And there's just a lot of uncertainty regarding the direction of both the current tariff announcements, the implications of countries whether they will choose to negotiate or to retaliate on what has been announced, and then thinking about both the first order effects on those around economic growth and inflation in a country, and then the second order effects of those, which really factor into thinking about weaker global demand and a potential for a global recession. Now, I would stress that there are a lot of questions we're getting from clients at the moment. Many still do not have answers. It does depend on the news flow coming out of Washington, and that is making things a little bit more difficult, especially in terms of the questions we get around tactical positioning in the market at the moment. A few clients coming back with, should we be thinking about this being the bottom, looking at indicators such as the VIX index and the spike there and thinking about, historically what the returns have been 12 months later from that. We would just be a little bit cautious around the tactical timing of the market at the moment, given the level of uncertainty, and given this is very much a policy-induced shock we're seeing to both markets and economies, and not fundamentally something to do with a weakness in the global or even a weakness in the US economy in such past periods of stress, such as what we had during COVID, or potentially thinking back to other periods around the great financial crisis or even the tech bubble bursting back in 2001. So getting into today's call, I really want to sort of talk about a couple of new slides we've put into the guide and thinking about that uncertainty and what we're seeing, and the fact that the position coming into the start of this year wasn't nearly as negative. This first page we have here, this is a new one looking at the survey data coming into the US. When we look at the hard data, so we look at GDP numbers, we look at jobs numbers, employment growth, or even things like industrial production and some components around PMI numbers, which are, again, survey data, they painted a relatively healthy position for the US economy, and we saw some improvement in those numbers in markets like both the European region as well as China, given some of the positive impacts of the policy announcements from last year. So we're very much in this frame of understanding that there was going to be a policy dynamic around tariffs coming into this quarter, that there was some uncertainty about the magnitude of those tariffs, but having an inkling for, a global economy and particularly a US economy that was on a relatively strong footing. You can see that we had a period of rising consumer confidence. Inflation was falling back in the US. We were thinking about the policy easing cycle having begun and extending further in many markets around the world. And again, we're thinking about, markets were not going to return, the numbers they did in 2023 or 2024 in the US. Still very healthy corporate balance sheets were feeding into relatively positive earnings outlook, and also thinking about a relatively healthy household balance sheet in the US as well that provided some resilience against some of those shocks. Obviously, the nature of what's been announced is significantly larger than many had estimated, including our own forecast for the size of these tariffs, and are seemingly getting increasingly higher by the day, given the most recent announcement about an additional 50% tariff on Chinese imports into the US. And so it is a case of thinking about the soft data that we're seeing now being probably more of an indicator of what we expect into the US economy, and feeding through into some of the soft data we're starting to see around the world. Even the Australian consumer confidence numbers were relatively weak that came out the other day. So on the left-hand side, you can see this is really reflected in the University of Michigan survey, and the grey line on the left-hand side, that has declined very sharply. It's been driven by rising inflation expectations. You can see that in the purple line. We've just inverted that axis to show how these things move together. And it's that concern both about the impact of tariff on raising prices, as well as some of the risks around the softening growth outlook that you're seeing in the US. So there's a bit of a dichotomy between what the hard data had been telling us about the US economy, and then again, what the soft data is starting to reflect in terms of this. You can see this in some of the broader business surveys as well. Again, if we look at the NFIB, National Federation of Small Business Survey, or even the CIO Optimism Survey there, you can see that the numbers had picked up running into the January inauguration. There was that expectation around an increase in tax cuts, the treatment of certain tax deductibles coming through, or even thinking about the support that may come through in terms of deregulation on parts of the economy that would aid that growth outlook. That has since rolled over, most notably on the small business side of things, but we did get a new CEO survey come out this week, and that grey line has also dropped materially. So we're seeing that weakness starting to be reflected on the business side in the US. And again, there's a number of headlines and news flow out at the moment, just sort of lamenting the number of CEOs who are now being critical of the policies that are coming out of the US and what it could mean for growth and inflation in the long run. So this weakness that is actually coming through at the moment may start to translate into the harder data we're seeing come out. But again, until we start to see that, the policy reaction from some central banks or the Federal Reserve, or even what we see from the US government, may be tempered a little bit because they're still sort of looking at the data, which is relatively resilient, even though we've had this policy announcement. But we would expect some of this softer data to start to translate into the weakness in the hard data as well. So when we look at the US economy, things have been doing quite well, but we would start to see them come through. We do have these concerns, obviously, around the growth outlook, given the size of the tariffs that have been announced. Our biggest issue, though, is whether they're going to be permanent or not. Now, if we take the White House at face value, they're saying that those tariffs are going to be permanent, but we do know they're undertaking a number of negotiations with different countries, which could see those reciprocal tariffs started to be phased back a little bit. Obviously, we'll be left with that 10% base tariff, but there are other carve-outs that are in there as well. And there is a question around import substitution, which may again see other sectors start to have some reprieve from what the final tariffs are. That just adds to the uncertainty about the growth outlook, but there is a growing case to say that if today's status quo, the level of tariffs stay as they are today, then that would have a significant chance of the US falling into recession. The offsetting impact of that, though, is that a lot of the policies that have been announced are a very different sequence to what we saw the last time we had President Trump in power during his first term. Back then, it was all about the pro-growth policies coming through earlier. We had those tax cuts being announced. This time, that sequencing has changed. It has been about tariffs. It has been about migration and trying to curb that. And there hasn't been so much to say around tax cuts and deregulation just yet. But we are expecting that to come through. And so contrasting the sell-off and the shock to the market at the moment with, say, periods like COVID or the JFC, there is some reason to see a path away from a downward drag in the economy to an extent, and thinking about how much this fiscal stimulus coming through could support economic growth. Now, there is a big question around what that fiscal stimulus may look like and how it's funded. On the left-hand side of this page, we just break down the federal budget in the US into different categories. And you can see on the right-hand side, in terms of the sources of revenue funding, tariffs are actually a very small part of that funding. So while they will add to government revenues, and probably more meaningfully so given the size of the tariffs that have been announced, it's still going to be pretty small in percentage terms. A lot more of it comes from other sources of funding, such as income tax. We may come back to that point about inequality from tariffs, how they impact the economy as a whole in the US. But you can see there is still a shortfall there. And even with other measures and reductions that have been announced, from the DOGE in terms of furloughing of employees in the government sector, postponing or cutting some contracts for work being done, that is still very small compared to the size of the deficit that you have in the US economy. If we do get an extension of the Tax Cuts and Jobs Act, which is widely expected, that's not really fiscal stimulus because it's just extending what's already in play. And that was already going to add to the size of the deficit and the debt as a share of GDP, as you can see on the right-hand side of the page. So there could be some constraints here in terms of what can be delivered on the fiscal side. However, we would argue that the weaker the outcome or weaker the economy looks over the next coming quarters, that will be a reason to see an increasing role of fiscal stimulus to come through to offset that, and probably more impetus from Republicans to try and deliver something for their constituents in terms of that fiscal side of things. This, however, could add to the inflationary outlook. We get fiscal stimulus at a time when supply is constrained. It would be a thinking around what we saw back in COVID, complicating the outlook for the Federal Reserve. But again, it's whether we see it come through tax deductions for, say, autos, which have been muted, whether it's tax deductibles for thinking about companies that are producing more onshore in the US, or if they pay a lower corporate tax rate, or alternatively, it has been muted if it's somewhat more of checks that are sent out to households to fuel consumption, given that it is the biggest component within the US economy. And that may fare more on creating inflation in this environment where it's supply constrained rather than the other one. So a lot of uncertainty around what that fiscal stimulus could be, the size of it, and how much it would actually offset it. But we would expect to see more of those policies at least start to being announced in terms of what could be delivered. And importantly, there's a reconciliation bill that's kind of working its way through Congress at the moment, which has flown under the radar a little bit given the other news that we've heard most recently. Now, on that inflation outlook, obviously the last time we had tariffs imposed by President Trump, that's the red line on this page. You can see there wasn't a huge inflationary consequence. They were relatively targeted against China, against a select number of goods and imports coming through. But this time we're coming from a point of view where inflation is only getting back down towards where the Federal Reserve wants it to be. And we're thinking more about the impact of the pass-through from producers onto consumers, as well as the increased cost if you do have more things being produced in the US. Obviously, the move to globalization was a move to lower cost production. What we're seeing of that is some reversal, and that does lead us to think about higher levels of inflation overall. Again, the question here is about how sticky it does become. Now, the Federal Reserve, perhaps rightly or wrongly so, when Jerome Powell was doing his most recent press conference, used the word transitory. Even if we did start to think about that being possible in terms of the year-on-year measurements of inflation and these things starting to wash out over a year, we would think about that pass-through actually being potentially easier for producers to pass on to consumers at the moment, given we have been through that period of higher inflation, and that's what we did see during the COVID pandemic. And again, if you took a relatively conservative estimate and you split the increase in cost 50-50 between companies absorbing it and passing it on, it would still add about 1.3 percentage points to inflation currently. So you get up to a number that's closer to 4%. And again, it would be driven at a time where the inflation outlook had been coming down rather than starting thinking about being sticky. But it's worth noting that in that box on that page, we've broken down core inflation there into both goods and services. So obviously core services inflation had been the problem during the pandemic because we had rising shelter costs, which were a very slow moving part of the inflation basket. And core goods, inflation there was virtually zero in February. This is where you're going to see the inflation consequences start to come through as that goods inflation starts to go up, even though you have relatively high services inflation still adding to the overall inflation outlook. What could bring that inflation down, though? Obviously, energy prices are falling quite steadily. Big falls in oil, both on the WTI side and Brent. That would detract from inflation on the headline level. It would also give households a bit of a reprieve. US households are particularly sensitive to the price of gasoline, given there's low tax rates. It's passed on pretty quickly at the pump for consumers, and may create some more breathing room if we think about disposable income. We'd also, think about the prospects of just weaker demand if the US economy did slow, how that may slow inflation a little bit more expected. So the inflation outlook here is, again, one where it's more likely to be higher, and it's more likely to be higher in the long run, but just how high in the short run is still up for debate. Our estimates aren't, though, thinking about a surge in inflation back to 9%, what we had in the pandemic. And again, thinking about the balance between some of it being perhaps transitory and pass through, and some of it being a little bit more sticky if you did get this reversal of thinking about higher cost production moving to the US and what that would actually mean. I think more of what we learned over the last few years is there's going to be more volatility around that inflation outlook. And that's probably what's most challenging when we think about portfolio construction and what it means for fixed income, particularly as we think about how to protect portfolios in this environment. On the monetary policy side, obviously, this creates a huge challenge for the Federal Reserve. The balance of rate cuts is now increasing, with the market increasingly pricing in 5 rate cuts. Talk of whether the Fed will even make it to the May FOMC before it actually does cut rates. And I think that that's a potentially a positive and a negative. If the Fed did come out with an emergency rate cut before its next meeting, that would send a very clear signal that it was more worried about the growth outlook for the US economy and the impact of these tariffs. And when it has done that in the past, it hasn't always led to a positive market movement. Now, the Fed has been increasingly patient when it's come to its messaging about wanting to see the impact of policies, wanting to see the impact in the hard data. I don't know if it has that luxury anymore, given that weakness we're seeing come through in the surveys and the magnitude of what has been announced in the last week. However, even if we do go back to, say, rolling back some of those reciprocal tariffs, you move back to a tariff rate that's not north of 25% on an effective basis going to the US, it's 15 or so. That's still going to have a drag on the US economy. That's still going to have to feed through into thinking about the Fed factoring in lower growth rates. And they're also going to have to contend with those higher inflation and how much they really want to treat it as transitory. On balance, we think the Federal Reserve will move to support growth over inflation and will be more biased towards the downside outlook for the US economy, leading to more rate cuts come through. At the moment, we still think there is scope for them to cut rates in May, but we have been looking for them to move from the middle of the year and do a little bit more on the policy easing bias in terms of thinking about the number of rate cuts from 2 to north of that now through the second half of the year. But again, it does come back to the fact that the narrative in the market could change very quickly if there is simply a policy announcement or a headline that comes out of the US administration, which just says they're pausing on the implementation of tariffs, or that they're thinking about changing the direction of them as they think about the negotiations that may be going on. And so the Fed will be very mindful of that as well in terms of front-running the market. For now, the market isn't seeing a big Fed put or a Trump put coming through. So I do think it's a case of thinking about further easing in policy than what had been expected. And that's very much showing up in terms of the fall in the short end of the curve that we had seen in terms of what we've seen in the market movements over the last few days. So definitely further easing. I think that's extending around the world as well. We would expect to see further easing coming through from the European Central Bank as well, given the shocks to growth, which I'll come on to. We're expecting further easing from central banks around Asia. Some already have been moving in that path as well. And again, thinking about further rate cuts from here in Australia, as well as in China, to stimulate the economy. So that easing cycle definitely kicking in and perhaps being a little bit more accelerated around the world to offset some of these shocks from growth. Now, on the case of Europe, just taking a little bit of a change of tact and thinking about the response from other markets to what we're seeing overall, there has been a case of thinking around why Europe had been doing very well in the first quarter. Obviously, the things that lagged last year have kind of flipped over into the first quarter of this year. The US market was already pretty soft ahead of this tariff announcement. Europe had been doing well. We'd seen a pickup in China and across emerging Asia as well. Japan's performance had reversed as well. Some of that was to do with relative valuations around the world. Some of it was to do with the policy response already in Europe coming through around both attitudes towards fiscal spending and defense spending, as well as the easing of policy rates that were going to lower financial conditions, and a bit of a pickup in the growth estimates as we saw consumer activity start to pick up. Now, Europe obviously is not a sort of has been through many crises over the years. We've had the Eurozone debt crisis, we've had tariffs in Europe before, obviously we've got the conflict between Ukraine and Europe, we've had Brexit. In pretty much all of those instances, the answer for Europe's problems was always more Europe. It was always a better collaboration across the countries in terms of trying to achieve a unified goal. And I think in some regards, the fact that there was a blanket European Union tariff levied against the region rather than individual countries, that has actually been a slight upside, or at least a silver lining, because it does allow the region to respond as one in terms of the ramifications, rather than each government trying to fight their own case, given if it was levied at the country level. But more importantly, when we think about the outlook for Europe, obviously a slowdown in trade would be significant for the growth and we have seen downgrades to that growth outlook come through this year from ones that had been rising. But the focus really is on the fiscal side of things and how much that can lift the growth outlook, or at least offset that drag that comes from the external sector and tariffs coming through. On the right hand of the side, defence spending had been very much in the focus, and you've seen that in the performance of defence stocks. And more importantly, obviously thinking about the relationship of the US with Europe, its vocal nature when it comes to spending regarding NATO. And you can see on the chart there, we've got the 2024 estimates for spending as a share of GDP from NATO, and then 2014. You can see the US there, the second group of bars from the right. They were spending around about 3.5% of GDP, much higher than most other European economies. And again, this was fueling the argument that these countries needed to pay more, given a lot of conflict was on their doorstep. In some cases like Poland, that had already happened because, they were very much closer to that eastern edge. And you have seen further announcements. Sweden announced that it was going to target a 3% GDP defence spending coming through. The expectations is that NATO will raise that guideline to 3.5% when it meets later in the year. But now we have Germany after the election announcing more defence spending was coming through, releasing that debt handbrake to allow for that and allow for broader fiscal spending overall. And you've seen an announcement around the 500 billion euro package on greener economy, on infrastructure spending, and really rebuilding the industrial base that has been lacking in Germany, and a reason that the growth outlook has been so weak there. And Germany has the ability to do that. So on the left-hand side, we're just looking at the debt level as a share of the economy. Green line is Germany. It's well down there. It's below 60%, which is the threshold that's set up under the Maastricht Treaty in the European Union. So they have scope to spend. They have the ability to use fiscal firepower to really drive the economy higher. Now, not every economy in Europe has that. So we look at the purple line, which is Europe ex-UK, and you can see that that's much higher. So we think about Italy, we think about France. They're fiscally constrained to a certain reason, but Germany, given the size it is in Europe, this is going to have very strong positive spillovers to the rest of the region. And we do think that fiscal thrust is really what's going to balance the outlook and say, well, maybe the European Union doesn't fall into recession. It's a pretty close call, even if the US does. And that's very different from what we've seen in the past, because generally a US recession has kind of been a necessary and a sufficient requirement for a global recession. But this time around, given the nature of the shock, and it really is the US kind of impinging itself by applying tariffs on the rest of the world, Europe's only putting tariffs on one country. And so we can think about how it can offset that, and that growth can come through. And again, how you might see more internal collaboration around these policies, this fiscal outlook, to allow that growth coming through. And I think, again, that may be reflected in terms of what we're seeing in asset prices, particularly around the currency, given the euro has been strengthening this year. And importantly, how investors start to position, diversify globally, which had already been happening, and why that may continue in the coming months. Now, China is a very similar situation. Obviously, we've been looking at the policy announcements for last year. They were starting to gain traction. Some of the economic data coming out after the Lunar New Year had been quite encouraging. Disinflation was still an issue, but there had been a big shift in the policy direction from the PBOC. The movement back towards tech, thinking about the allowance of profitability in some of these companies that have been very different under some of the common prosperity rules that have come through. And that obviously then fueled a bit higher when we think about the announcement around AI and DeepSeek and what that did to the market. You can kind of see on the right-hand side of the page, if we look at the credit impulse in China, that grey line had been moving up quite swiftly. It had been funded a lot by the government and the announcements to increase the deficit and issue greater levels of government bonds. You'd also start to see at least signs of stability in the property market as well. Primary and secondary house prices weren't falling by as much as they had been. And you're seeing a bit of a clear out. We look at some of the floor space started and sold numbers as well, suggesting you're getting at least past the worst of it in the housing market, if not back to a positive level. But we do know that the Chinese officials can do more. Obviously, they've taken a very different approach to many other markets around the world in terms of announcing retaliatory tariffs against the US, curbing the export of certain rare earths and other things, really trying to inflict as much damage onto the US as they think is being done to them. Now, that could continue to escalate. And for now, at least, the policy measures that China does have, it hasn't actually had to deploy yet, but we would expect them to do more on the policy rate side when it comes to monetary policy, so triple R cuts, further easing of short-term lending numbers to try and create that. But it is going to be fiscal spending that does the heavy lifting. They could potentially do more around government bond issuance. They're thinking more around potentially raising that deficit level again to fund that. And I think on balance, while the focus has been on driving domestic consumption and that consumer package they've seen come through, they may start to lean back in towards some of those, well-oiled and well-trodden paths around infrastructure spend. That's really perhaps going to have more of a positive shorter-term impact on growth. We're now facing some serious drags on growth, given, again, the first-order effects and the size of those tariffs that have been announced and the second-order effects around the potential slowdown demand globally and in the US for their goods. So it could be a case of China moving back to some of those older policies that can create that growth in the near term, and then, again, focusing on some of those more structural-driven issues to drive that domestic consumption higher to lead to that longer-term growth outlook as it tries to achieve that 5% growth target for the year. The other thing here, obviously, and what has been seen more recently, is the use of the currency. We have the Chinese yuan nudging up about 7.3. It's been depreciating lately. We've seen a bit more flexibility in those flexing prices come through. During the 2018-19 period with the Chinese currency, it sold off or depreciated about 7%. But the magnitude of those tariffs were much, much smaller. So there is a question around efficacy of how much they would have to depreciate the currency at the moment to really offset the size of these tariffs, and then balancing that out with what has been a more short-term policy around currency stability and thinking about the impact on capital outflows from a movement in the currency as well. So our base case is that you may see depreciation in the currency, but I think they'll be looking more at that stability and those risks around capital outflows rather than using it as an outright tool to offset the pressures around those tariffs as now, or they can lean into some of those more fiscal sided things to try and drive growth overall. But it is a tool at their disposal. I wouldn't rule anything out for now in terms of what happens given the size of these tariffs and what could be announced from both the US and Chinese government over the coming days. So what does that mean for markets? It means diversification. It means balance. It means thinking about any outside positions that you may have had in your portfolios and what really works in times of volatility. The first thing that has proven to work has been the outlook for core bonds. We did see yields fall. We saw prices go up as the market sold off. Even with some of those inflationary concerns, that move towards safe havens did work. So it is about focusing on core more in portfolios when it comes to fixed income. A very simple chart on the screen in front of you, just showing you the relationship between falling yields and rising prices and returns in the bond market. If we do think about the Fed doing more, if we do move to a recession in the US, there is scope for the Fed to cut policies a lot more. You could get down to 3% or potentially lower, depending on the depth and magnitude of that recession and how the Fed views inflation. And so that could mean meaningful returns in the fixed income market from today's level. Now, it does have to be balanced around some of those inflationary views and how much duration you want to take in a portfolio. So we do look more still at the sort of more intermediate portion of the curve, the belly of the curve, and thinking about that, given that there are some of those risks around what may create a flaw in the longer term end if there are those inflation concerns that start to be built in to the bond market. And we see that or create a flaw in how far yields could come down. But by and large, it does really argue for saying, even in periods where inflation has been a concern and we have seen those correlations between equities and stocks and bonds move higher, that has been tested in terms of coming down more recently. And that correlation doesn't have to be negative for it to be effective in a portfolio. Even if that correlation between stocks and bonds is zero, you are getting a diversification benefit. And more importantly, you are getting a hedge against what could be potentially quite meaningful growth shock in the US and around the world. And there is a potential to diversify that duration exposure across markets such as Europe, for example, as well as the US, or thinking about Australia as well, given the higher relative yield we have and the carry that is on offer. Outside of the core bond space, thinking about the credit market. Now, one of our preferred markets had been thinking about both investment grade and high yield. We saw the attractiveness of the yield that was on offer, thinking about the boost to total returns, and what that actually means for portfolio. We had been looking at the underlying metrics within the credit space. Again, coming back to good corporate fundamentals, relatively good leverage ratios, thinking about interest cost ratios that were also quite attractive. But we have seen spreads widen out. Now, in the investment grade spreads, this data is from the end of March. And the investment grade spreads, US investment grades are now closer to about 135. So they have widened a little bit, but not nearly as much as we've seen Treasury yields move. So somewhat of a cushion there. And we have seen US high yield spreads move out to about 450. So getting closer to that long run average. And again, going beneath the surface on that high yield number, it is some of the more consumer retail parts of the high yield index that are showing the bigger movements. Some of the autos, for example, as well, pharmaceuticals, if you want to get into it, things that are seeing the reflective nature of those tariffs. But other parts and other segments within the high yield space haven't moved nearly as much and are kind of a little bit lower as well. So again, the active nature of being very much key when it comes to the outlook for credit markets as well, particularly at the index level, given the number of bonds that are in these indexes. We would argue that this is a time to be thinking up in quality, though, when it comes to the credit space. So again, leaning more into the investment grade space. The risk that yields do move meaningfully higher and high yield, if we do get a recession where they typically go to 800 basis points and north, is very much there. Given the quality fundamentals we are seeing in the space, that may not be the case there. But again, given the deterioration we could see in the economy, those spreads in high yield are probably going to be more sensitive than the spreads we're obviously seeing in the investment credit space. And we'll be leaning more into the IG space in terms of thinking again about core allocations within fixed income in this environment. On the equity side, again, questions coming in more recently have been around where is the bottom? Have valuations come down enough? There's been a very big movement in the US market. Just checking this morning, the valuation on the S&P 500 was 18 times. It had been closer to 22 times coming into the start of the year. Long run average is closer to about 16 if we look at the last 10 or so years, so above that. But there has been arguments around why the US market has been moving up in terms of that valuation multiple. To put that in context, usually when we look at drawdowns of this magnitude in the US market, the valuations tend to bottom out around about 14 times. Now, that has been a guide in the past, but again, given the big movements we've seen in multiples, particularly within a small segment of the US market, that may not be the best guide in the future. But certainly the fact that multiples are falling, that de-rating has moved through, it's really removed what was a 2024 concern around the size of the multiple expansion and moved the focus to thinking about, have we really seen the earnings downgrades come through when it's very difficult for analysts to start, pumping numbers into their Excel spreadsheets when they're not exactly sure of the outlook. Now, the earnings growth numbers for the US had moved from 13% for this year down to 11%. You're definitely probably going to see those downgrades come through in the coming weeks, particularly as the US earnings season comes off. And you may be looking at something that's more close to single middle digits when it comes to the earnings outlook in the US now. There is a case for thinking about the resilience in US companies, how good they are at protecting their margins. But more again, this is a case of thinking about, with your US exposure, has it been too far into growth? Can you balance it out between growth and value and what you're seeing? And also, can we think about moving into other parts of the market? And that rotation that we had been talking about earlier in the year, you can see the top right-hand side. And again, these numbers are now going to be a little stale given they're from the end of the quarter, but that expectation that you had seen a rising share of earnings growth coming through from the non-mega cap names. And so we would argue that the US economy, the US equity market, the de-rating that has come through, it's now about the earnings downgrades that we look at it. It does represent a quality market if we think about return on equities. Valuation de-rating, it has come through a long way. It's more about finding that balance between growth and valuation when it comes to that, and also cyclical and defensive. So really removing some of those style biases from your allocation there. And the second point about that diversification is again about globally. Now, I had worked through the first part of this year and into later last year. We saw Europe start to come back, and we saw China start to reform. But again, we would be arguing that those relative discounts were very much in play with the US to Europe, and some of it being driven by the sector composition of those markets and the higher weight towards growth and tech in US relative to Europe. The left-hand side just shows you that even with that sector composition, the European market had been trading at multiples well below what they would normally do historically. And so we had seen that earnings growth number come back through at a time when multiples had been weak. And so that was a case for thinking more neutral towards Europe rather than underweight. I think there's still a case for that as we think about potentially the economic impact that's going to happen within Europe relative to the US. And again, the valuation is still being relatively lower when it comes to the US market in Europe. The second thing I would note there is, again, the income stream. So in times of stress, we will think more around income-generating strategies. Now, this can be done either because we had seen an increase in share buybacks in Europe that had come through and dividends been coming through that increased shareholder returns in Europe has been something that's particularly a US phenomenon for a while and now becoming more global. And also thinking about the use of derivative strategies and driving that income in a high volatile environment, protecting some of that downside risk, which has become increasingly popular. And again, an income generating strategy that can offset some of those potential risks around capital losses. And that plays through globally as well. I mean, the chart on the left, this is one we've had in the guide to the markets for a while, just shows you the annualized volatility being lower, the returns being higher when you think about the high dividend parts of the market. The right-hand side just showing you the grey line that right up until the end of the last quarter, the higher dividend component of an all-country world index had been trading at close to a 30% discount to the regular all-country world index. That has narrowed a little bit, but the green line shows you we're getting a pickup on the difference in that dividend as well. So income-bearing strategies across the equity space, as well as the fixed income space, being very important consideration for portfolios, as again, you balance the income versus growth outlook for your portfolio. The other thing I would note is around the outlook for diversification in portfolios and private markets. Now, not a new thing that we've been talking about, but clearly fixed income can have that role in protecting you against that growth shocks. And we do still think about the fall in government bond yields should there be a big recession. The complicating factor is that inflation outlook in short run and the long run and that volatility and that inflation. Now, this has been a driving force for a while now about why we've seen many investors move towards real assets in particular, where you get a higher income and you're getting a very much a lower volatility and a lower correlation in portfolios. The chart on the left just illustrates that, the horizontal axis there being the 10-year correlation to a 60-40 portfolio, the vertical axis there being the annualized return of that asset over the last decade, and then the size of the bubble representing the income from that as well. So the big blue bubbles there of transport, infrastructure, they have that low correlation, that strong income that's predictable given the nature of these contracted cash flows, often to utilities in the infrastructure space, the ability to pass through inflation in some of those contracts and how they're regulated, particularly in the infrastructure space. But we can also see other things like real estate, a little bit more sensitive to the economic cycle, but can be coming from a position where, particularly in the US, you have very low valuations on the US market. Or even if we want to think about other things in terms of hedge funds, which do well when there is higher rates for volatility and have a relatively low correlation to your portfolio as well. So I think within the private market space, a range of opportunities thinking about diversification and income generation to protect against those inflation shocks and protect against private market shocks, and that low correlation being a key feature at the moment. I want to finish with one chart before coming on to questions. This is really the chart that summarizes it for us. It's way in the back of the Guide to Markets Asia, but perhaps it should be at the front. This chart shows you how a 60-40 portfolio performed versus cash during different periods of stress. So on the page, we have 13 different periods of stress. So we go back from the Gulf War in the 1990s all the way up to the Russian-Ukraine conflict of 2022. And you can see on a 1-year and a 3-year time horizon how that 60-40 did better or performed relative to cash, We assume that you vest 1 month before that particular crisis happened. So you can say, for example, in the my eyesight's not very good. In the Gulf War crisis, you can see that the 60-40 portfolio 1 year after the start of that crisis beat cash by 28%. 3 years later, it beat cash by 46%. Now, if you run your eye across that, it's not perfect. About half the time, 1 year later, that 60-40 has beaten cash, and it's more likely about 11 times on a 3-year basis. Cash is people hiding in the market. We're not here to hide. We're here to invest. We're here to be protecting our portfolios. Core is better than cash in our view when it comes to that. And so this is just a reminder when we're talking to investors, or perhaps when you're talking to your own clients, that they're thinking about safety, they're thinking about cash. Cash rates are coming down. There's going to be a big reinvestment risk there, and the ability to actually think more actively across both equities, fixed income, and alternatives, and how they can protect themselves, derive income, and have a performance that does beat cash over a longer run basis. Unfortunately, David wasn't able to join us due to technical difficulties. We apologize for that. I will run through some of the slides he was going to talk to really, really briefly around the tariff impact. The first one being this. I would just note that if you do go to the Policy Hub section of the website for your country, they've got the JP Morgan Asset Management one, the Market Insight section, you'll see a trade section of that. We have a lot of our charts updated more frequently. You can also get the daily guide to the markets for Asia, which has a lot of these charts now refreshed every day, and so you have the latest data there. But this tariff chart really says it all. We're going back to a period that is going to be worse than the 1930s. And in fact, the tariff rates are now, if we do get the extra tariff on China, 104%, and the worst since the 1900s when this data really goes back. It's very extreme, and this does explain the action in the market. No one was expecting tariffs of this size, and no one was expecting tariffs to be calculated on the reciprocal basis they were, which really does beg the question of are they reciprocal tariffs, or are they there to try and level the playing field when it comes to deficits? And there's no guarantee that these tariffs will do that, given the way that they are levered on these economies and the ability for the US to actually just produce things others want to buy, or the fact that the US does tend to rely on the rest of the world for consumption because it doesn't produce these things domestically. And that has been a long-running feature of why there is these deficits with countries. It's not necessarily a negative towards the US economy. It's just been a function of how the US's economy has operated when it does tend to live beyond its means. And so that makes these negotiations very difficult, and it makes the impact of these tariffs very large. So I would stress there's a few notes from our team that have come out. You can talk about this, that run through the size and nature of these impacts, how they're calculated, what was expected relative to what we saw. Again, the numbers here a little bit tepid. Absolute basis, no one wins from this trade war. Like literally no one wins. Everyone's getting a worse growth outlook and changes to their inflation outlook. On a relative basis, you can say there were some winners and potentially some losers. Asia as a region, unfortunately, did receive higher tariff rates than many other markets around the world, perhaps focused on the fact you'd seen those rising deficits with the US because of the transshipments from China, and the US is trying to tackle that. Mexico and Canada did get a reprieve from the reciprocal tariffs, given they have the USMCA, and that had already been discussed to a certain degree, and there was actually a few more carve-outs put in place. Latin America also got off relatively lightly with only a 10% tariff base, as did Australia. And as I mentioned, even Europe, the fact that it was levied at the regional level rather than Pacific countries could be seen as somewhat of a silver lining. And then Japan being a focus around perhaps more of the negotiations that may take place shortly, but the auto tariffs relative to the overall lifting tariffs that has come through. I would say one thing that David wanted to talk about in terms of what this actually means and the negative consequences is this chart here. I think it's a very good chart. He did a much better job in explaining than I would, but I would just go through it and say, you can see the top 10% of income on the left-hand side and how they spend it. A lot more of it goes into savings. A lot more of it goes into services spending. If you contrast that with the bar on the right, that is the bottom 90% of basically households in the US. Their spending is very different. A lot less of their spending goes into savings, and a lot more of it goes into goods. If we think about one of the things that the White House and President Trump has talked about, he's talked about having revenue generation that was more similar to the 1930s, where a lot more of it came from tariffs and a lot less of it came from corporate and household income tax. That may be the end goal. No one really knows what the end goal is at this point, but the ramifications of that is probably going to drive inequality. The US government was much smaller share of the economy back then than it is now, and it is likely to be that those top 10% of households disproportionately benefit from the tariffs because they just don't spend as much on goods. and therefore they're not going to be paying for these things as the bottom 90% do. They're really going to wear the fact that their paychecks get eaten up by those higher costs that come through, and the consumer base could really be eroded by this in the US, and don't necessarily have that big change come through. So the inequality and the regressive reform of this taxation is something we're very mindful of in terms of what it could do for the economy overall. That is the end of the call. I have taken up the whole time. If you have any questions about any of this at all, please reach out to your client advisor. If you have any questions from your own clients that you would like to get answers to, there's a plethora of information on our website. We have updating our daily guide at Asia every morning to get the latest market data, economic data in there. We've got decks on trade and tariff that show you how things are changing on a daily basis as well as a number of notes that we're writing around this to keep up with the movements in the market, as well as to keep that flow of information out to your clients. And again, thank you for your time this morning and listening to the call. All the best for the markets today.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.